The fire alarms are ringing, and the canaries in the coal mines are dropping dead. When you thought the financial experts had it all figured out, Cathie Wood drops a bomb with her economic warnings of troubling times ahead. Cathie Wood, an American investor and the co-founder CEO of ARK Invest, is sounding the alarms. Miss Wood's fund performance took a nosedive in 2022, falling almost 70% in the last 3 quarters, because the Fed doesn't seem to be learning the lessons of the previous intense crunch back in the 80s. In a recent interview, Miss Wood offered some incredible predictions for the upcoming months, and it's nothing you'd hope to expect. Her brutally honest outlook on the economy ahead is a stark warning to the world. Let's take this seriously, coming from somebody who has everything to lose if the economic woes are truly up ahead. So, what is it that she had to say? Why is she so upset at the Fed? What warnings did she offer that we all need to pay attention to? Tune in and buckle up, because you're about to go for a bumpy ride. Some early signs. Cathie Wood has taken a close look at the rate hikes Fed Chairman Paul Volcker raised in the early 1980s, and noticed that the importance of the recent rate hikes we're seeing today had exceeded any of that era. Those hikes suppressed the decade-long inflation the United States has suffered in the 70s, but not before a severe recession. She also highlighted the massive drop in consumer sentiment, a factor that has hit its lowest levels in the last 80 years. An indicator that Miss Wood pointed at the environment of raw resources and natural materials such as lumber, which is a crucial juncture for predicting deflation. You heard that right, deflation. But wait, isn't that a good thing? That should be what we want. Shouldn't we want historic inflation to go in the opposite direction? Hang tight. We'll explain shortly why Cathie Wood isn't as stoked about deflation as you think she should be. So getting back into it, Miss Wood also cited that gold has been steadily dropping over the last 2 years, a contrast to the 1970s, which saw gold skyrocket in response to inflation. Miss Wood's discontent with rate hikes confuses many analysts. Other experts, such as Doble Line's Jeffrey Gundlach, have argued that the Fed is acting appropriately by aggressively hiking rates, with how lousy inflation is. Still wondering what all of this means? We warned you it was going to be a bumpy ride. Cathie Wood's prophecy. Key economic issue is deflation, not inflation. In her own words, the economy is in recession. Opposite of what the White House is reporting, Cathie Wood reiterated her view that the economy is not doing just fine, but it's in a full recession. No matter how often the White House and Wikipedia change the definition of a recession, the chief executive of a leading investment management firm is sticking to her words. Miss Wood isn't taken aback by the historic 9.1% increase in the price of consumer goods. The lagging indicator for problems is deflation, not inflation. Fiscal policy is the one deflationary force. Miss Wood said that the growth of federal outlays is dropping drastically. Economists love to compare the current financial crisis to the 1970s, but she points out that federal spending growth never fell back then. Miss Wood said monetary policy is restrictive. On the monetary front, in addition to the Federal Reserve's interest rate hikes, M2 money supply growth has lessened from 27% in 2020 to about 5% in July. Miss Wood believes that it could drop down to 1% growth by the end of this year. According to Miss Wood, we shouldn't worry about leading indicators for inflation. What she points to is the trading price of gold. In August 2020, gold peaked at $1,700 to $2,000 an ounce and is currently sitting at about $1,800. That goes opposite to pointing toward increasing inflation, Miss Wood said. Another indicator was copper peaking last year and oil cresting in March earlier this year. No more bang for your buck. Throughout the COVID pandemic, companies had gotten used to seeing pricing power. According to Cathie Wood, those same companies didn't think sales would capitulate, but they did. Inventories have blown out. For example, builders are now stuck with home inventories. With excess inventory, companies only have one way of eliminating their products: slashing prices. Miss Wood points to where these price cuts are taking place. She says to look at what's happening at Walmart and Target. That will show up in inflation numbers, Wood said. Regarding recessions, Miss Wood would like to turn our attention from the White House and over to history, where leading indicators have dropped for 3 straight months. If we're to learn from the past 40 years, that is a sign of recession. The Fed makes a move. So far, the Fed has been focused on lagging indicators for employment and inflation. Initial unemployment claims exceed 55% from their celebrated low earlier this year. According to Cathie Wood, the Fed will probably meet that with a pivot away from rate increases within 3 to 6 months. On top of all of that, another indicator of a recession is the yield curve's inversion. An inverted yield curve occurs when short-term Treasury yields exceed long-term yields. The 2-year Treasury showed 3.28% compared to the 10-year Treasury's 2.8%. The economy is showing significant signs of inventory recession, but it's nothing like the systemic recession of 2008 to 2009. It's a garden variety recession. We think the economy will come out of it in 2023, when most economists expect a recession to begin. A method to the madness. According to Cathie Wood, the Fed won't increase rates as drastically as markets have prepared for. Ms. Wood's ARK Innovation ETF is down 45% and suggests that inflation could start dropping. That would give the Fed enough courage to ease the tightening of rates. She claims the Fed will not hike rates as much as current firms are bracing for. This forecast goes entirely against what the rest of Wall Street is preparing. Some financial institutions are doom prepping for rate hikes to spike as high as 0.75% at each turn. Cathie Wood has wrestled with the fear of inflation, but thinks that markets have experienced the prospect of the Fed tightening its grip over the market. Ms. Wood expects inflation to settle down in a whiplash-like fashion. She claims that'll give the Fed room to relax and chill out on the purported rate hikes. Looking closely at the painted scenario that Ms. Wood presents, we see her company ARK Innovation ETF would receive a massive boost. The financial guru Ms. Woods said there could be a surprise in terms of interest rates not going up as much as the market has priced in. Some speculate that Ms. Wood's stance and optimism about the Fed easing up is based on self-interest. Of course, she would hope that the Fed would take the path that would best serve her company and investors. But could there be anything outside of self-interest for her to make such bold predictions? Well, to get to the bottom of that, we'll need to broaden our investigation and take a look internationally. Much of the demand for commodities like nickel and copper, oil, wheat, and other consumer goods comes from China, the world's second-largest economy. The Chinese government insists on maintaining a zero-COVID policy. Major cities all over China, such as Beijing, Shanghai, and others, are experiencing draconian measures and lockdowns, keeping entire populations stuck at home. These measures have slowed the once booming economy of China, and demand is tapering off as China pushes closer to the point of collapse. The experts are laughing at China's target of economic growth of 5.5%. At the rate they are locking down the entire country, containers are waiting haphazardly at ghost town ports next to closed down factories with idle assembly lines. That translates into the U.S. becoming the primary provider and producer for many countries worldwide. That could provide the release valve that the Fed needs to combat the highest level of inflation that we've seen in over 40 years. Demand for oil from China is preventing further rallies, as bonds and stocks are slumping. While the Fed is worried about inflation, we still don't know if they're willing to destroy the economy for short-term gains. Although Ms. Wood may inject her beliefs into her market predictions, there may be some method to the madness in her contrarian views of what the U.S. Federal Reserve may or may not do next. In an ever-changing economy with its ups and downs, we ought to take all of this with a grain of salt. We should prepare for every eventuality, but not at the expense of the long term. We'll be able to drive closer to the truth in the coming months. A lot of this rides on what exactly the Fed will do, something not even they are sure about.